Indiacharts publishes Nifty daily video updates, the weekly Elliott wave outlook, and the long-short report covering all asset classes.
Hi, I'm Jay Vora from Indiacharts, and today in this video we'll have a look at the long-term structure of S&P and the possible outcomes that can occur in the short to medium term. So let's quickly look at the chart of S&P. So this is the monthly chart of S&P, and you can see that in the long term, it has been rising higher in the channel, but only at the end of 21-22, there has been some throwover at the upper end, and later on it has been followed by a sharp correction. So such scenarios, wherein we see a price moving higher above the channel, this part, these are typically known as throwovers, and that occurs when there is excess optimism. And when we try to combine it with Elliott wave, then you can see that there has been a clear 5-wave rise from the 2009 low. Now, it can be debatable, whether this recent rise from the COVID low of 2020, whether this is just one of 5 or the end of 5 wave. So this is an ongoing debate which we will probably know once the the short to medium term structure unfolds in the coming weeks and months. But as we can see right now, that there has been a correction. And typically you would see that whenever there has been some deeper corrections, at the 40-month moving average, the bulls have almost made a comeback, and they have defended these levels. So this time it has been no different. S&P has once again managed to bounce back from the 40-month average. Now you can see that there has been a lot of bad news that is flowing for S&P, and the US market, wherein the inflation is running high. But, despite of all of that, the S&P has still managed to bounce back. So why is that so? So that is because, S&P for the first time after 2020 has pulled back to the 40-month average. Okay, now this is very crucial from the medium to long term perspective. So typically you would see some sort of fight from the bulls when it comes to defending the 40-month average. So this is what has happened in the near term as well. And while many of the people are a bit surprised as to why this move is happening, we at Indiacharts had clearly published that there can be a case for a deeper pullback. Now let's examine why. So when I go to the weekly chart, you can see that there has been a leading diagonal in this entire fall, right? So what does it mean is that this is wave 1, this is wave 2, this is wave 3, this is wave 4, and this is wave 5, and this entire fall is wave A. Okay, now what typically happens is that whenever this 5-wave decline, now many of you might not know, but a leading diagonal can typically occur in wave 1 or it can occur in wave A. But what it essentially means is that that once the fall is over and then the pullback is complete, it will be followed by next leg of correction. Now that can be wave 3 or that can be wave C, that needs to be seen in the as in when the correction unfolds. But in this case, just to be on the conservative side, you can take this fall as wave A. And now pullback typically tends to occur towards the it retraces back to the high of wave 4. So in this case, S&P has almost retraced back to the high of wave 4. Now the 40-week exponential average is at 4187. And also when you look at in terms of retracement, so it is very much near to the 50% retracement mark. Okay, so in the very short to, in the very near term, there is a scope for a pullback up to the 40-week exponential, which is 4187, or there is even a possibility for an overshoot, and you can see a pullback up to 4228, which is the 50% retracement. That can also lead to the RMI completing its pullback cycle as well, wherein it is back to the zero line. But around these levels, there is a high possibility of S&P finding a meaningful resistance. So typically after that, you would expect that once this pullback is complete, it will be followed by next leg of correction. Okay, and what we mean by next leg of correction is basically the entire equality of wave A can unfold in wave C. Now the interesting part is that, assuming that we say that the pullback might end somewhere around the 50% retracement mark. Okay, so let me take the equality level. So when I take the equality level from the 50% retracement mark, that also coincidentally coincides with the 61.8% retracement level of the entire fall. Okay, so in the near term we expect some bit of pullback to occur in S&P, but once that is done, there is a high possibility that wave C can unfold, wherein the 61.8% retracement mark, which is around the 3200 mark, we can see that in S&P. And if that is broken, okay, so we can say that maybe this entire move is a 5-wave rise, and we might see a deeper correction in the medium to long term. But as of now, let's not go there, and let us just understand what is the setup in the near term. And like I mentioned, that maybe in the near term a pullback up to the 40-week average or the 50% retracement mark, which is around the 4220 level, that is possible. And post which we expect a correction in wave C to come by, wherein it can probably go down till 3205 to 3190. That is the equality level of wave A.